So in our previous lecture, we already started discussing our topic 5. So topic 5 is a source of finance. So this is your topic, source of finance. So in this source of finance, we discussed two different types of source of finance we have, right? Internal source of finance and external source of finance. External source of finance. And we discussed in the previous session that we have three different types of internal source of finance. That's involve selling product and services, right? Selling product and services. Internal source of finance means organic source of finance. We also call it organic because company generate by itself. Second, internal source of finance is selling assets. If any kinds of assets that company is holding and that asset is not in use anymore, so company going to sell that assets to raise some funds to and company reinvest that money back in a company in order to maximize its productivity and profitability. So so selling assets. Selling assets. Okay. And the third source of finance that we also discussed in the previous session was a retained earning. Retained earning. So another name of retained earning, we also call it internal equity. Internal equity. So instead of company giving any dividend to their shareholders, company hold their dividend and company reinvest their dividend back in a company. That's called the retained earning. Whatever money left in the company after paying all kinds of expenses, that's called retained earning, right? Okay. So these are the internal source of finance that we discussed. We already started external source of finance as well in our previous class. So in external source of finance, we have three different types of source of finance that we studied before. So we have these three different types of external source of finance. So in this one, we have a short-term external, long-term external, and the other. So we have a short-term, external, long-term external, and others. Right? Others. So short-term external source of finance, can you tell me what did we cover in the last lecture for short-term external source of finance? Tell me which source of finance we covered in the last session. External, short-term. So we covered hire purchase, purchased. We covered commercial credit card or bank overdraft. So commercial credit cards, or bank overdraft, bank OD. OD stands for overdraft. And factoring accounts receivable. Factoring accounts receivable. So these three short-term source of finance we studied in the last session. So this is the thing that we studied in the last session. So now we continue with the next short-term external source of finance. So next one is a building society. Building society. So what is building society? Another name of building society, we can call it either building society, or we can call them pawn shops. Right. The pawn shops or building society. Now, what does it mean, building society? For example, if you want to borrow a small amount of money, not so big, right? And if you want to borrow a small amount of money, but you do not go to bank. First reason is that you need a small money. Second reason is you cannot meet all the conditions that banks implemented on lending money. So for example, you must have a reliable market value of your assets that you're going to mortgage for the bank. Second thing is you must have regular cash inflows in your bank account. So you must have a regular income. So you will be able to return all interest or all kinds of money back to bank on time, right? And your records, your previous record, you never been involved in any kinds of default activities or some other kinds of things, right? So banks implemented certain conditions if you want to borrow money from banks. So that's why sometimes for some people, it's not really possible for them to borrow from bank. So these kinds of people, they go to these building societies or pawn shops. So what they're going to do, they mortgage their small assets to borrow money. So for example, you're having a laptop. You will mortgage your laptop to these shops to borrow money from these shops, right? If you return that money back to these shops with interest, you will get your laptop back within a time period. If you do not, of course, you lose your laptop. All right. So of course, you have to return money back to these private institutions or private shops or businesses on time. Right. This is called a building society. In Vietnam, it's extremely common, these kinds of building societies or pawn shops. Anybody knows what you call them in Vietnamese? Any idea what you call in Vietnamese? Tell me. Yes, that's right. We call it condo. That's what you call in Vietnamese. I don't know how to write it like this. And maybe something like this, right? So yes, so condo is another name of that's kind of building society. But there is a problem, not a problem. No, we should say that advantages and disadvantages for these kinds of building societies or pawn shops. Like its bank has its own advantages and disadvantages. Similarly, building societies and pawn shops, they have certain kinds of advantages and disadvantages. Instead of talking about advantages and disadvantages, let's discuss about the difference between building societies and banks. All right, borrow money from building societies and borrow money from banks. So let's discuss about the difference. So here, difference between building societies and bank loan. Right, so we borrowing money from bank or building societies. So that's building society and that's bank loan. Right. And that's bank loan. Okay, so can you tell me what is the difference? You know already, Kamdo, so what is the difference? Tell me the first difference. Tell me. First difference is a rate of interest. Rate of interest under building societies and bank loan. In bank loan, rate of interest is standardized. All right, not really standardized. We call it, it's a controlled interest rates, because you know that banks are highly supervised by the state bank or federal reserves, right, or central bank. I mean, in government bodies, it's regulated, is strictly regulated by the government bodies. So means the interest rate that bank charge on the lending. So of course, that's not 100% depends upon banks, whatever interest rate they want to choose it. No, it depends upon the government, whatever interest rate or whatever threshold or whatever the limits the government has decided, banks follow those limits to lend money to the people, and people will pay interest following that interest rate, right? So these interest rates are well controlled, all right, well controlled. And okay, we will come back later. Building societies still can use the stuff, we will discuss later. So interest rate in building societies are kinds of uncontrolled, partially uncontrolled, we can call it. What does it mean? So you know that when you borrow money from these building societies gonna charge a very high interest, very high interest, sometimes 20%, 30%, sometimes 50%. And I have seen that some people are paying like 100% interest. You borrow, let's say 10 million Vietnam dong for, I don't know, 4 or 5 months, and you have to return 20 millions back to those people. I hope you know that too, right? Because many people in Vietnam, they may mortgage their documents of their lands and buildings to get some money, and then probably they cross the border to go to the neighbor countries to go for casinos or go involved in some kinds of gambling activities illegally. I don't know, I'm not sure, but it's just an example that they don't really care that how much interest rate they are offering. They just need the money. So the whatever interest rate they charge by them, they are willing to pay that interest rate to those building societies, right? Okay, so this is the first difference. Second difference, you write down that building society can still use the stuff. Now, what do you mean by use the stuff? Can you explain to me, use the stuff? Such as vehicles. Yeah, yes, they can use there some kinds of yes, that's true. Okay. Mortgage, so we can call it mortgage. Nature of mortgage, nature of assets. All right, whatever assets you gonna, yes, we will come to this point too. Nature of assets, the same thing that you mentioned here. Nature of assets means you can mortgage whatever you like, as long as that item has a market value. You can mortgage to get money from these building societies. Small items, big item, big assets, small assets, your laptops, your mobile phones, your cameras, your motorbike, your bicycles, right? Your TV, maybe, I don't know, your fan, or whatever things you want to mortgage, you can. So they are free to accept whatever assets you have in exchange to get money. However, banks, they have a certain categories. So following those certain categories, you can mortgage only those types of assets. You cannot mortgage whatever you like it. All right. So any assets you can mortgage, right? Nature of assets to mortgage. All right. And bank loan, certain assets. Right. So this is the second type of difference here. Okay. Next, you write down bank requires some conditions before lending us the money. Yes, no any. We call them easy borrowing. Easy borrowing. That's easy borrowing, not easy to borrow from banks, because as you mentioned, they require various conditions. Various condition is reliable assets or certain assets which is come under the categories of their asset that you can mortgage, your regular income, your bank balance, or not really bank balance, but your regular cash inflows or your previous records of lending or some kind of other things. These are the differences between building society and bank loan. Any other difference, building society and bank loan? Any other? Another major difference in building society and bank loan is that if you borrow money from bank, you have to pay interest, and that interest can help you to reduce tax. So that interest is your tax shield if you borrow from banks. But if you borrow from these building societies or the pawn shops, I don't think so that interest that you are paying, it's a tax shields. Why? Because first thing is that you are not involved in a proper documentations. Even in fact, in Vietnam, I think some of these building societies are illegal, because if you are charging 100% rate of interest from the borrower, I don't think so that that's kind of businesses are legal, because this sounds like really ripping off the customers by charging like 100% rate of interest. Yes, there are some certain building societies in Vietnam, right? But if you want to take any kinds of tax advantage, then obviously you choose the bank loan instead of building society, because when you are applying, when you are submitting your tax return, when you submit your tax documents, of course you have to show some reliable evidences, right? So tax benefits, tax benefits. I don't think so. So tax benefits. Tax benefits means, again, it's like tax shields. So these are the differences, maybe some more, but that's enough for us to understand the differences between building societies and the bank loan. Now we go back to our next short-term source of finance is a trade credit. Okay, so now after your building society, the next short-term source of finance is a trade credit. Now, what does it mean, trade credit? Trade credit exactly like as accounts payable. Now, what does it mean, accounts payable? Explain to me. What is the meaning of accounts payable? We have to pay. What do you mean by we have to pay? Really clear. We have to pay. We pay to supplier. Why we pay to supplier? Yes. So accounts payable means when you purchase raw material on credit, that's called accounts payable. So it means credit purchase. So now this is your obligations to return money back to supplier on time. So means you are, without paying any single dollar, when you receive material, that's called trade credit. When you are trade, okay, now what does it mean, trade? Trade means buying and selling. Credit means without money, without cash. No, not without money, without cash. When you do business without cash payments, that's called the trade credit. So under trade credit, companies, we can say that company is borrowing material from the supplier, borrow material from supplier, which has a money value. But of course, company does not need to return material back to supplier. In exchange, company will return money back to a supplier after a period, 1 month, 2 months, it depends. So this is called a trade credit, and trade credit is also source of finance. Source of finance means you need finance. So you need finance to purchase material. Instead of purchasing material, you are directly buying material, right? You're directly buying material. So this is your trade credit, purchasing material on credit. You got material to continue your production and your operating activities. Now, next, is bank loan, short-term bank loan. We should call it short-term bank loan. Short-term bank loan means, short-term bank loan. You're borrowing money from bank for short period of time. Maximum period is 1 year. So you borrow money from bank for 1 year and you return money back to bank within a year. That's called the short-term source of finance. Now, next source of finance, short-term source of finance is operating lease. We should call it lease. Then I will explain you what is the meaning of operating lease. So lease, operating, right? There are two types of lease. Now, first of all, we need to understand what is the meaning of lease. Lease means rent, renting, rent anything. Whatever you are renting, it could be machines, it could be buildings, it could be land, it could be equipments, it could be vehicle, anything you are renting, that's called lease, right? That's called lease. Whatever you rent, right? Whatever you rent, that's called leasing or lease. Now, there are two types of lease: operating lease, finance lease. Operating lease is a short-term source of finance, and finance lease or capital lease, sometimes we call it capital lease, sometimes we call it finance lease. And finance lease is your long-term source of finance. So I'm explaining both at the same time. So let me write down here, long-term. Long-term. So that's your long-term. So long-term, we have also lease, and this lease is a finance lease or capital lease. Finance or capital. Now, let's understand the meaning of lease first, a little bit more in detail, not just simply by saying that it's rent. What is the definition or what is the meaning of lease? And then we will find out the difference between operating lease and finance lease. All right. So lease. Lease means, okay, you need to understand risk and reward. Before you understand the meaning of lease, we need to understand the meaning of risk and reward. All right. Again, lease means rent. If you're gonna rent any kinds of assets, you have a risk of that assets and you have a reward from that assets. So that's the meaning of risk and reward. Risk means you have to spend money to maintain the assets, repair the assets, right? That's called risk. Whatever cause to increase your cash outflows or increase your expenditure or increase your outflow of economic benefits. That's called the risk. Reward means you have cash inflow, you make money, inflow of economic benefits, right? That's called the reward. Reward means something give you benefits, give you profit, give you income, and risk means something maybe because of your loss, whatever loss you have to bear, that's risk. Repair, maintenance, whatever expenses belongs to that asset, you have to pay. That's called risk and reward related to assets. Now, in lease, there are two parties, obviously two parties. One is a owner, right? Another one is a customer, all right? So of course, we don't call it owner and customer. We call it lessor and lessee, right? Lessor means the owner of the property, owner of the assets. We call them lessor. Owner, landlord, if you're talking about the house and buildings, landlord is the owner, and tenants are the lessee. Tenant means customer who need that assets for the leasing purpose, right? So we call them customer. Okay. So that's now what is the meaning of lease? Lease means without changing the ownership, when risk and reward transfer from lessor to lessee, that's called lease. All right. So I write down here. So what does it mean, lease? Lease means without transferring the ownership. Without transferring the ownership, the exchange of risk and reward. Risk and reward, exchange of risk and reward between lessor and lessee. All right. This is called lease. This is called the rent. Without transferring ownership. Without ownership. Without ownership means under lease, lessee, who is a customer, never become the owner. Now, what does it mean, owner? Owner means the tenant or the customer or lessee cannot sell this asset. All right. Lessee do not have right to sell the asset because it doesn't have an ownership. If you want to sell the asset, of course, you have to be owner of the asset, right? So without transferring the ownership, when you exchange risk and reward between lessor and lessee, that's called the lease. Now, what does it mean, exchange of risk and reward? This exchange of risk and reward will differentiate operating lease from finance lease. With the help of the difference between operating and finance lease, we will understand what is the meaning of exchange. All right, so now let's find out the difference between operating lease and finance lease. So, operating lease. Operating lease means Operating lease is a lease in which risk and reward do not transfer from lessor to lessee. So lessor to lessee. Risk and reward do not transfer from lessor to lessee. What does it mean? It means risk belongs to lessor and reward also belongs to lessor. Lessee doesn't have any risk related to that assets, and lessee doesn't have any reward from the assets. Lessee doesn't have any risk from the assets, and lessor doesn't have any, and lessee doesn't have any reward from the assets as well. So risk and reward stay or belongs to the lessor, not transfer. Now, what does it mean? What is the example of operating lease? Example of operating lease is, we have some other examples here, but I'm giving you very simple example of operating lease. The examples could be a hotel room. So you know that whenever we travel in another city or country, we stay in a hotel, right? So hotel are the examples of operating lease. How can we understand hotels are examples of operating lease? How we know that? Again, it also belongs to risk and reward. For example, let's say you travel in another city and you rent a hotel room to stay. In that hotel, if your air condition, your TV, maybe some other electronics items have any other technical problem, do you have to pay for it? Or the owner of the hotel has to fix or has to pay? Tell me, who will pay? Customer or the owner of the hotel? Again, if room has any technical problem, whatever electronics equipments in the room, and the room has a technical problem, owner has to pay, right? That's the meaning of risk of that assets belongs to lessor, belongs to the owner, right? Risk of the assets belongs to the owner, right? Now, for example, you rent that hotel room. You book that room for, let's say, 5 days. So you tell the hotel that I will stay in this room for 5 days, and you already paid all the advance money and something like that. Now, after 3 days, you have an urgent call to go back to your home or go back to your city where you live. So, but it's just 3 days. Now 2 days left. Now, can you rent this room to another person for 2 days because you paid money for 5 days? Can you do that? Can you make money by using your hotel room? Can customer do that? Yes or no? No, of course not. You can't do that. Hotel will not allow you to do that because that's hotel assets. Let's take another example. Can you You're renting a hotel room. Can you open your business over there? Can you do business over there in that room? No, of course not. So business means reward. You want to take some reward. You want to take some benefits from that assets. Can you do that? No. The owner of the hotel can do that? Yes. That hotel belongs to him or her. So they can do whatever they like. But the customer, they don't have right to make money by using that assets. That's called the operating lease. Remember, I am giving you example of hotel room. I'm not giving you example of renting a room for the private owner, not the commercial purpose. I'm not talking about that one. In Vietnam, in Ho Chi Minh City, some people, they do that. They rent a room and they put that room to rent to someone else. That's not an operating lease. That is the finance lease. All right. So hotel room, exactly example of the operating lease. Let me give you another example. For example, you travel in another city. You need a car or you need a motorbike. So you're gonna rent a car or rent a motorbike. So this is operating lease. Before you rent a motorbike, if motorbike has any kinds of technical problem, customer has to pay? No, of course not. Company has to pay for it, any technical problem. So risk belongs to the owner. Reward. Can the person who is renting a car, can that person use that car to make money? No, of course not. That's the purpose of that car, is not for the commercial purpose. They can't use it. They can't become a taxi driver. Generally, they don't do that, but they cannot make any changes in that car. They can't, if they don't like the color of car, they can't paint the car. Customer can't do that. If they don't like the wheels cup or something, they can't change the wheel covers. If they don't like anything seat covers in the car, they can't change it. They don't have a right to take rewards from that assets. Only owner has right to take rewards from the asset, benefit of the assets. This is called the operating lease. You can't make any changes in the assets. Assets stay as you borrow it. Right? So that's the meaning of operating lease. Now, finance lease, which is long-term source of finance. Now, what does it mean, finance lease? Finance lease is the lease in which risk and reward transfer from lessee to lessor, right? Risk and reward transfer from lessor to lessee. Now, what does it mean? For example, I rent a room, all right? And we sign a contract that this room is empty, nothing in that room. So the customer who's gonna rent this room will fix air con by him or herself, right? They have to fix the air con. Whatever changes they wanna make in a room, they can make it. Owner doesn't mind it. But when you return that room back to the owner, make sure you return in a same condition as you take it very first time as per the contract. This is called a finance lease. All right. This is called a finance lease. In simple language, you rent a room. I'm giving just room. You can take another examples too. Just take it very simple. So just take example of room. I rent a room. I can do whatever I like in that room. I rent a room. I can live in that room. I can open a food shop in that room. I can open a clothes shops in the room. I can do any kinds of business I like it in that room. This is called finance lease. If anything broke down in the room, I have to fix it. So risk belongs to lessee. Reward, I can use that room to do any kinds of business, but I can't sell it. I can't sell the room because as the meaning of rent. Finance lease means you can do whatever you like in that room, but you can't sell the room. Of course not, because you're not an owner, right? This is called a finance lease. The best example of finance lease is a malls. In the malls, they have a small shops or some court, like food court or any other clothes court or whatever. So malls, you can rent a shop over there. You open a clothes shop. You open a coffee shop. You open a shoe shop. You open a teaching center. They don't care. All right. But when you return that shop back to the owner after contract is finished, you have to return in the same previous conditions. That's called the finance lease. You can, even though in the mall, if you want, you can leave it. But of course, nobody live there because it's quite expensive there. So you can do whatever you like. All right. So that's why sometimes you have seen some advertisements on the street. They write down of operating lease for office. Operating lease for office means if you will lease this building or this floor or this room, you can only open a business, only open an office. You can't live there. I don't know, for example. Right? Even though in Vietnam, in Ho Chi Minh City, some apartments, if you live in those apartments, they give very clear-cut instruction. If you rent this, for example, if you take example of like Vinhome, maybe some other apartments, if you live there, you cannot run a business. You can't open a business. You can't open a shop in your house. So that's why they also build a shop house. Shop house, you can live and do the business, but they have one floor for the shop house, other floors for the residential purpose. So the idea is that you cannot open a business over there. That's apartment only for residential purpose, not for the business purpose, because if you open a business over there, people will complain and this and that. Exactly same purpose for the operating lease. You want to open a business, if some you live over there, is going to be noisy for the neighbors, it's going to be noisy for you, some kinds of problem and things going to happen. That is the difference between operating and finance lease. So I give you example for hotels and malls, but you don't have to remember the examples. You just need to understand the most important thing is risk and reward. Is it transfer or do not transfer? If risk and reward do not transfer, that's operating lease. If risk and reward transfer, that's finance lease. All right. So that's all for short-term source of finance. So short-term for source of finance is finished. Let me check. We have lease, cards. Yes, that's all for short-term source of finance. Okay, so now let's move on to the long-term source of finance. So remember, we have a long-term and we have others. We have three different source of finance. We have others, three different source of finance. So let's talk about the long-term source of finance. So long-term source of finance, we already discussed. The first is a lease, operating lease. Second is a bond. Same like as we discussed before, different types of bonds, corporate bonds, municipal bonds, and so on. So bonds are long-term source of finance. And third long-term source of finance is stocks, selling stocks. And you know types of stocks, preference stocks and common stocks. What are the difference, their rights and types and dividend, whatever that we covered before. So third long-term source of finance is stocks, that you also know that, so we don't have to explain about it. And the fourth long-term source of finance is a long-term bank loan. Long-term bank loan, that you also know that. All right. So we have four different kinds of long-term source of finance: lease, bonds, stocks, and bank loan. All right. So short-term and long-term source of finance are finished. Any question? Any question, yes or no? We have 7 parts. Yes, 7 parts involve hire purchase, right? Second one was the bank overdraft. Third was bank loan. Fourth was building society. Fifth was trade credit. Sixth was lease. And one more, I guess, factoring. Yes, so 7, factoring. Yes, so we have a 7 short-term source of finance. Okay. 7 short-term sources. So any question? Any other question? Say something, any questions or not? So Katwi is absent today. Nathan is absent. And Nyatki also absent. And Tung Bak also absent. So 1, 2, 3, 4. 4 students are absent today. Right? So yes, we can have a break now. And after break, we will continue with the last source of finance, which is others. And then we will finish this topic 5. And then we will see if we have time, we can start topic 6. Otherwise, we will start in the next class. All right. So we can have a break. So I'll see you soon. Thank you. Now, the next is external organic source of finance. So, inorganic source of finance. So this inorganic source of finance, we call it merger and acquisition. So basically mergers. So mergers are, do you know what is the meaning of merger? Mergers. Merger means when two companies collaborate with each other. That's called mergers. So when one company is collaborating with another company, then obviously that company is taking the resources of the other company. In other words, we can say that both companies are taking a resources of each other's. So obviously, these kinds of mergers are providing some kind of resource, direct resource to the other companies, right? So this is called a mergers. Merger also a source of finance, external or inorganic source of finance. Why inorganic? Of course, because you are taking support of the other company. Other company going to collaborate with you. So that's why it's external source of finance. You're taking support of the other company. That's called external source of finance. Now, let's talk about the types of mergers. There are 3 types of mergers: horizontal, vertical, and conglomerate. Horizontal merger. Second one is vertical merger. And the third type of merger is a conglomerate. So what is horizontal merger? Yeah, any question? Anybody, any question? Horizontal merger. So you can see the name horizontal. Horizontal means like this, horizontal. So let's say this is company A and company B. When company A merge with company B, but company A and B, they have a same level. What does it mean, same level? Yes, the company gonna produce same kinds of, okay, they have a same level. Now, what do you mean by the same level? Same level means they have a same level. Same level means same market, same customer, and same product and services. When company are in a same industry means same product and same services, right? So same product and services, same customer, same market. So if these company going to collaborate with each other, that's collaboration is called a vertical merger. Oh, sorry, horizontal mergers. What companies are at the same level, right? Let's say two electronics companies, they're going to merge with each others, or two banks, they're going to merge with each others. That's called horizontal merger, right? Next is a vertical merger. Vertical merger will be like this: A to B. They are not same. They have a different level. They have a different level. But of course, they have a connection. Different level, but connected with each others. Connected with each other. Or they have some kinds of relation. Connected means they have some relation. They have a relation. So different level. Different level means they have different market, different customer, and different product and services. That's called vertical mergers. So what could be example of vertical merger? The example of vertical merger could be, so examples could be when one company is buying raw material from the other companies. When one company buy material from the other companies, that's called a vertical merger. For example, merge with supplier. If you merge with your suppliers, that could be your vertical merger. So let's say you have a two company. Company A is about motor industry. Right. And company B is steel industry. All right. Company A and company B. So company A market is automobiles, motor industry. Customers who buy vehicles, right? Product, car, trucks, bikes, whatever. So they're in terms of market, in terms of customers, in terms of product and service, they are different. Steel industry, they have a different market. Manufacturing, of course, manufacturing, but in manufacturing, they are more about steel. They are not different from they are different from the motors. Customers, steel industry, not only the companies who are producing cars and vehicles, they are buying a steel, but many other companies, they're also buying the steel. Depends in which profession we are using a steel, in which company or manufacturing sector we are using a steel. So they are not only supplying to the motors, they're supplying to many, right? Product and services. Steel company, they supply steel or irons, right? Or metals. And motor companies, they are supplying cars, vehicles. So they are different. But when motor company and steel company, they have a relation. What relations they have? Motor company buy steel from the steel manufacturers because cars require a steel, right? So they are buying a material from their supplier. So its vertical merger is generally when there is a merge between company and its suppliers. When company and company supplier going to merge together in order to capture the market, that's kind of merger called vertical merger. All right? That's kind of merger called vertical merger. The third merger is a conglomerate. Conglomerate means these two companies, they have a different level and they are not connected with each other directly or indirectly, right? So A and B, they're going to merge together. It means they have different level. Different level means they have no relations at all. They are not connected with each other in any manner. Right? They have different level and no direct and indirect connection. With each other. That's called conglomerate. So what could be example of conglomerate? Let's take example of conglomerate is like as bank and steel industry, bank and other manufacturing industry. Bank is a service sectors. They are providing service. They have different market. They have different customers. They have different product and service. Let's say steel manufacturers, different market, different customer, different product and service. Besides all this, they have no relations at all. Banks are not taking any services to this company, and this company is not taking any other services from this bank. This kind of merger is called conglomerate. All right. So this is external, inorganic source of finance.
So can you repeat again about the example of the third one, the third merger?
Conglomerate?
Yeah.
Okay. So conglomerate is a merger between any two companies, any two industries. They are not directly or indirectly associated with each other. They have no connections at all. Like as I give you example of, let's take example of private university and the banks. All right. Banks, they are providing financial services, right? Private universities, they are providing educational services. Both are providing services, that's fine. But of course, the nature of service is different market. One from the financial sectors, one from the education sectors. They are different customers. Banks who require financial services and universities who require educational services. Banks, they have different products, different services. Universities, they have different teachings, different qualifications, different level of educations, right? So this is called conglomerate. No relations at all. That's why conglomerate different from verticals. In verticals, company also different from each others, but they have some kinds of relations, maybe direct or indirect relations. But generally, in conglomerate, they come from different sectors, completely different from different sectors. But verticals merger, companies could be same sectors, like as manufacturing, motor, manufacturing sector, steel, also manufacturing sector. That's why they require services from each others. That's why motors require raw material from the steel. But in conglomerate, one could be manufacturing, another one could be non-manufacturing. They are not providing any kinds of services to each others. When they're gonna merge, that's called conglomerate. Again, the purpose of this kind of merger is to capture the market. All right. Is that okay? Yes or no?
But I still wonder how do they affect about daily finance?
How they
Finance.
How they affect the finance? Because okay, they have a resource. That's, you have to understand what is the meaning of merger. Merger means when two companies comes together. When they comes together, this company taking a resource of this company and this company taking use of resource of this company. The purpose of merger is to provide the resources, resource acquisition, no matter it's a vertical, no matter it's a conglomerate, or no matter it's a horizontal. The purpose is resource. When one company going to acquire another company, or when one company going to merge with another company, they're gonna take the resources from each others. Not only the resources, they also have a positive impacts on the other business. That's the give may impact on the another business. Like as one company, very good market reputation of this company. When this company and this company just okay, when this company going to merge with this company have a positive impact, market reputations, not because of this, because of this merger. That is the purpose of this merger. It's not just transferring of funds. It's of course is about the resource, but of course the impacts on the markets that may attract more customers, that may attract more investors. That's also kind of some financial support that company gonna get it, and that help company to grow itself. So that's why conglomerate also useful. And another good thing about conglomerate is that it's also cover and targets the markets. It's covered the markets. One company providing various services, one company in a different sectors, not just a one sector. All right, so that's why conglomerate company, if there is a conglomerate mergers, company also grow faster, targets or cover the market more faster. That's the purpose behind it. Understand, Yatana?
Yeah, thank you.
Any other question? Any question? Topic 5. So now topic 5 is finished. If no questions, then can we stop here? If no questions, then can we stop, or any question?